It's finally happened. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the unexpected just hit the U.S. economy, and this is something the political elite said would not happen. And at the same time, we predicted it would. And with the holiday season fast approaching, the timing of this couldn't be worse. And speaking of political elites, you might be surprised to find out that there's one I actually agree with. You'll find out more later in today's show, but let's kick things off with the headline. Country Garden set to avoid yuan bond default after holder deal. You know, we talk about China's property developers because we know that if they are not the catalyst for the next global financial crisis, they're going to be immediately following whoever leads the world down. And we made mention that indeed the bondholders would eventually capitulate and agree to a term because the alternative option is go to liquidation. And at this time where there's a global dollar shortage and the global economy is slowing down, you get to find out the real value of your assets may actually be far less than you actually think. And then that would have a domino effect into other property developers, into the banking system, and lead to perhaps all-out chaos with the Chinese property developers. Nobody wants that happening. And so the builder, which defaulted on a dollar bond for the first time in October, has also prepared cash to repay at least a couple holders of the local note who bucked the trend and still plan to exercise their options. So I want to note here, not only are they defaulting on their dollar bonds, they're defaulting on their yuan bonds. And you can see the contagion risk here inside the Chinese property developers is outrageously large and could spread quickly to the rest of the world. And that's indeed why these bondholders and the courts do not want this to get out of control anytime soon. The development means that Country Garden, helmed by one of China's richest women, is set to avoid any immediate worsening in its crisis. Well, at least for now, that is. Because if we head over to Japan, we know that input inflation eases further to the slowest pace since 2021. And this is important because as we talk about inflation, many people believe that it's now entrenched in our society. They believe for decades that it was only a matter of time before inflation came back and that it became permanent. In fact, even our central bankers, those political elites, they believe that inflation could come back in a big way like it did in the 1970s. Of course, we showed you in yesterday's show that the likely probability of that is exceptionally low, but they still believe it. And one thing that's important to look at is input prices going to the factory because it tells you what's coming out on the other side. And Japan's producer the price index, a measure of input prices for firms, rose a mere 0.3% from a year earlier, the weakest pace of growth since February 2021, when the index fell by 0.9%. November marked the 11th straight month in which the pace slowed. So notably, the trend here for input prices into the factory has been slowing for 11 months straight. So that's not something you typically see during a period where inflation is likely to come back. You'd want to see a trend change where, yes, it's been decelerating and then it flipped and start accelerating higher. Again, no signs of that at all. Economists merely forecast a 0.1% increase, and from prior month, prices rose 0.2%. But here's the real issue. As we look at the U.S. data, we have the producer price index by final demand shown in red, the U.S. Consumer Price Index in blue, both on a year-over-year rate of change. And what do we see? A very strong relationship here that says where producer prices go, consumer prices follow. And all this is telling us is that what we're seeing is a decline in demand. And the one way you don't get inflation is through a decline in demand. And yet, for some reason, there's this belief that wholesalers, retailers, manufacturers, people are just going to continue to raise their prices because, well, that's what inflation does. And amidst the fact that consumers want to buy less and less and less at higher prices because they don't have the incomes or the money to afford it, but yet somehow that's what everyone believes. But indeed, as history proves, if demand goes down, inflation eventually follows. And one thing that's plunging, well, that's crude oil. As oil plunges near June lows as signs of oversupplied market mount. Remember, it wasn't just long ago that we were talking about how OPEC and many of these experts said that, you know what, crude oil prices are going to go to $150 a barrel, $200 a barrel. We said, well, you know what? Maybe that could happen, but it's highly unlikely. In fact, with everything seeming to start turning lower, many people are asking, can you make money in this market? Well, the answer is absolutely you can. Let me show you, in fact, one of our trades on QQQ. This is the NASDAQ 100, the largest traded ETF, up 9.5%. So many people, they say, Steve, I'm really bearish. I'm really concerned about the economy, but yet the market goes up. How do I successfully trade that without getting myself obliterated? Well, we give you the tools, my friend. This is our CTA Timer Pro. We've noted that the machines are driving so much money in the market that where they go, other investors follow in terms of hedge funds, institutional, retail, money follows. And what do we note? That back on October 9th, that we saw the machine positioning coming off a short position and continuing to buy. That was our first indicator for our subscribers on our CTA Timer Pro report. Then in turn, we said, look, a lot of our most successful traders subscribe to both reports. Our Momentum Timer Pro looks at those technical indicators like the RSI, the MACD, the Stoch, and all those things, and it smooths them out, and it tells you on October 9th, we had a pair signal, a one daily buy count, and that said that would have indicated a buy at open again on October 9th. That trade is up 9.5% right now, and it's as simple as that, because when the indicators reverse, it tells you when to get out. So yes, you can be concerned about the economy and yet still make monies in the markets. That's what we help you do. There are 3 coupon codes for CTA and Momentum Timer Pro for a free month, so you can get started, make some money, and find out why you too will be a long-term subscriber. Check out the links in the description. If the codes are gone, it's because 3 people beat you to it. Got to be quick. West Texas Intermediate plunged as much as 3.4% to below 69 a barrel, near the lowest since late June. And the reason we're talking about crude, it makes a big difference here in our lead story, as crude has slid for 7 straight weeks, even with new output cuts by OPEC and its allies failing to halt the skid. Now, what we've talked about in the past, that domestic economies and a debt-based system, they need cheap energy to grow. And what's happened is OPEC and their allies have tried to raise prices up when we really need prices to come down, because if you think about inflation, which we're going to talk about later in today's show, what do people spend their money on? On food, housing, and energy. Well, your food doesn't typically change too much. Your housing definitely doesn't change too much in the long term of schemes, but in the short term, energy prices can have a massive impact on discretionary spending. So as the global economy slows, what OPEC could do to support it would be to turn on the floodgates, flood the market with oil, drop energy prices down so consumers can get a hold of their debt and keep spending, and that would turn around the global economy and demand for energy. But this is going to have a real big impact now as we head into our lead story. As Ernst & Young says, it's cutting U.S. jobs, delaying the start date for new hires. You know, this is something we keep hearing from the political elites, is that the U.S. labor market is strong and robust. We've made the case repeatedly why it is not, why a slowdown in demand will lead to more U.S. workers hitting the unemployment line. We said it was likely to happen close to the holidays when people started realizing demand was going away. And look at what they said. This isn't just about the layoffs. It's about the reason behind them. And they're not the only ones. As Ernst & Young and his rivals have said, a growing number of clients, here you go, shelving longer-term investments as they navigate an uncertain macroeconomic environment, meaning there's less work for their consultants to come in and advise companies on. And if they're shelving long-term projects, what does that mean for the workers at those companies? Well, you don't need as many of them either. We'll look to see more people hit the unemployment line. It's a stark turnaround from just a few years ago when a pandemic-induced boom in demand spurred hiring sprees across the industry. But they're not the only one laying off, as Hasbro cutting 1,100 jobs after sluggish toy sales persist into the holidays. You know, so we talk about the unexpected. And what have we been hearing? There's going to be a soft landing. That means the labor market's going to cool off a little bit, but because it's so strong, so robust, there's so much consumer demand that we're going to roar off into a major bull market economy, and just coming into the next year. We said highly unlikely to happen. And yet, what are we seeing into the holidays as we look at what's going on with Hasbro? Why would they be laying off? They should see booming sales. They're seeing just the opposite. CEO said the move was spurred by weaker than expected toy sales. That doesn't sound like a soft landing. Through the first 9 months of the year, which came after sales hit, quote, historic pandemic-driven highs, of course, you give people money, they spend it. And the challenges have stuck around through the holiday season are expected to continue into next year. And that, again, that doesn't line up with a soft landing. That says money conditions are tight, financial conditions are tight, and consumers are cash-strapped in a big way. The market headwinds we anticipated have proven to be stronger and more persistent than planned. While we're confident in the future of Hasbro, the current environment demands that we do more, and that means lay off a bunch of our staff. And this just comes at the worst possible time, because if you go into the holiday season and you see a major toy maker start to say, look, our sales are not looking good, what does this mean for everybody else? The announcement just 2 weeks before Christmas comes as toy companies enter their busiest time of the year, making this even worse. About half of toy companies' yearly sales come in the weeks leading up to the holiday. They get a make or break stretch for manufacturers, and they're already telling us, look, this isn't working at all. We're not seeing the numbers we should see, and they've got to get ahead of laying off people before they run into financial trouble as well. Again, what happens with Hasbro, you think about the retailers. If demand at the manufacturer level is down, what about the wholesalers? What about the retailers? Well, they're going to need to lay off people too. As Hasbro has been hit hard as shoppers pull back, something that was not expected. In October, Hasbro said expected sales to drop a whopping 15% this year after previously forecasting a 3 to 5% decline. The lowered view came as the company posted its fourth consecutive quarterly loss on a 10% drop in third quarter sales. So you take quarterly losses after a while. Well, there's only one thing you need to do, and that's cut your expenses. The biggest one being employees, because you don't need them when you got a bunch of inventory sitting around. And this comes right back to the crude oil market. It tells us so much about demand, because here you can see crude oil prices. This is West Texas Intermediate, shown on a year-over-year rate of change against continued unemployment claims. And want you to see that when you have large declines on a year-on-year rate of change in crude oil, well, you eventually tend to get big increases in continued unemployment claims. They tend to coincide with each other, suggesting that if crude oil continues its decline, we're going to see more people on the unemployment line. And that means bad news for retail sales. And you can see this beautiful relationship between crude oil and advanced retail sales, both shown on a year-over-year rate of change. And we can note that crude oil is telling us when there is demand, what happens for energy? Price goes up because people are out consuming. And that means, of course, demand from retail. And what happens when energy prices go down? It tells us where demand's going. And look at just how much it matches into what you see in advanced retail sales here. But U.S. consumer prices pick up in a bumpy path down for inflation. And notably, that's the big concern, because we're going to hear from the Federal Reserve tomorrow. We can largely expect this is going to be one of the most boring press conferences they could ever have, because everybody already knows they're not hiking. They're likely to threaten one more, but that wouldn't be anything unexpected coming out of Powell's mouth, because he's been talking about one potential more hike. But we know he's going to stand firm and say, look, we're going to hold rates here until inflation comes down, and then it's going to come crumbling down, and they're going to be chasing to zero in a big way. The Consumer Price Index ticked up after being little change in October. When stripping out food and energy costs, the so-called core CPI accelerated on a monthly basis as well. This according to government figures. And why this matters is because, as we've noted, inflation is still running higher than wages. This is a problem, because when that happens, people have less to spend. You have less to spend, demand goes down, inflation eventually follows. The issue here is wages aren't keeping up. And if employers like Hasbro cannot make money, again, you have repeated quarterly losses, that means they're cutting, not giving people raises. They've got to cut. There's more demand leaving this economy on a weekly basis that's going to lead to a big decline in consumer prices and a massive recession. And we can note that Consumer Price Index has everything to do with U.S. regular all formations gas prices. That's shown in red in both on a year-over-year rate of change. And we can note that the downward pressures of energy are going to keep dragging the Consumer Price Index down. But yet, we're talking about the core here is everybody's fixated on that, including the Fed, because after all, we can't cut rates. We can't even stop thinking about hiking rates even until the core comes down. But I want you to see the core moves very slowly. So this is giving the Fed an excuse to say, hey, wait a minute, we see that the headline inflation rate's coming down, but it's really volatile. So we're going to stand pat on the fact that the core, which excludes food and energy, well, that's not moving much at all. But guess what? It doesn't. In fact, we can see during recessions, in fact, looking at the last two, where the CPI index came crumbling down, the core moved relatively slow in comparison. So yes, it follows the headline CPI with a lag, and it's only a matter of time before it gets down there. The issue being, well, there's one big problem. And here you can see the CPI month over month was up a mere 0.1%. You put enough of these roughly 0 to 0.1% gains on the line, and what do you have for your CPI? Well, you get it down to 0. That isn't the issue here. The issue is fixated on the core, which is up 0.3% because it increases in rent, and we know there's a lot of apartments being built, yet medical care and motor vehicle insurance, and eventually that will kind of cool off, because used car prices, while they weren't up for the first time in May, as demand goes down, those too will fall. But the big issue is shelter prices, which make up about a third of the overall CPI index, rose 0.4%, offsetting a decline in gasoline prices. Economists see a sustained moderation in the shelter category as key to bringing core inflation down to the Fed's target. They are absolutely right about that. But here's the issue. The core, you look at shelter prices, it's a huge lag. And as you can see in this chart here, you can note that even in the last two recessions, shelter prices in red, they came slowly down, and that's the pace they're at now, suggesting that the core CPI may actually stay above the Fed's target, even though the actual headline could show deflation at some point when the U.S. economy grinds to a halt. But as I started the show out, I mentioned there's one political elite they actually agree with. Well, at least for today. As Yellen sees inflation gradually heading back to the Fed's 2% target, what I agree with, it is headed back to 2%, and she says she doesn't believe that the last mile in returning inflation to the Federal Reserve's 2% goal will be difficult. And no, Miss Yellen, I agree with you. It won't be difficult when we are in the midst of a recession and a financial crisis. It won't be a problem at all. So in that case, we're in complete agreement. But she says inflation is certainly meaningfully coming down, and she adds she saw no reason why inflation shouldn't gradually decline to levels that are consistent with the Fed's mandate and targets. Well, Ms. Yellen, the reason it's not going to be gradual is because your friends over at the Fed, they have tightened money supply so much by inverting the yield curves and the money curves that they've constricted the creation of credit, because the banks indeed aren't creating a lot of new money. And when they don't do that, inflation doesn't gradually come down. It comes crashing down. And here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes against the consumer price index. That's shown in red and on a year-on-year rate of change. And we can note that when banks are tightening standards, that's any time that blue line is above that horizontal black line. What happens to inflation? Well, indeed comes crashing down. The path forward, Miss Yellen, won't be gradual. It's going to be rapid. And just like your predecessors, you're going to see Jerome Powell cutting rates in a big way when we try to deal with the fact we went from very high inflation to all of a sudden outright deflation. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.